Okay, good afternoon, everyone. Thank you all for joining us. It's great to be back with the Institute for another webinar. Just by way of introduction, my name is Andy Dixon, and I'm Business Development Manager here at Harvest. And I'm joined today by my fellow Business Development Manager, Emer Kirk. Excuse me. So we're going to talk about self-administered pensions and various aspects of self-administered pensions, but just by way of housekeeping, a couple of housekeeping notes. If you do have any questions, then just use the Q&A chat box. It should be at the top or bottom of your screen, and we'll take all questions. We'll answer all the questions at the end. And as well as that, the Institute have asked us to include a 1-minute break during the presentation as part of their virtual health initiative. So I'll do that just before I hand over to Emer, but the webinar will continue then after that. So please just bear with us for a minute. So in terms of what we're going to cover today, we are looking at some sort of key client considerations around self-administered pensions. And the first thing I'm going to look at is just some of the basic differences between what we would call insured pensions. So an executive pension plan, say through Aviva or Irish Life, and a self-administered pension provided by one of the pensioner trustee firms. I'm just then going to look at IORP2, which is a pretty significant piece of incoming EU legislation, which it'll have an impact on all occupational pension schemes in Ireland, but it will also affect one-man individual occupational self-administered schemes. So I'm going to talk about some of the implications of IORP2. And then just going back to insured pensions, and in the context of a client who's considering making a move from insured to self-administered, I'm going to talk about a couple of scenarios where you might develop different fund accumulation strategies, some of the ways in which clients might plan to make that switch from insured to self-administered. And then I'm going to finish up just by looking at some of the retirement planning considerations that are unique or specific to self-administered pension schemes as opposed to insured pension schemes. We'll then take our 1-minute break, and I'll hand over to Emer. And Emer's going to cover some of the investment options within self-administered schemes, and then some ways in which clients can address different concerns, say, or different objectives, say, for example, liquidity or income distributions for clients who are in retirement already. So firstly, just in terms of a comparison between an insured pension plan with, say, Aviva in this example, and a self-administered pension plan, there are a number of differences, but just in practical terms, probably the most fundamental difference is what happens to the premiums, be they employer or employee pension contributions going into that plan, and how they're invested, and how that process works through. So with an insured executive pension plan, the client will typically make a decision at the point of completing the application form, say, in conjunction with their advisor as to what they're going to invest their pension premiums in. And most of in fact, all of the life companies now will have a range of these risk-rated multi-asset portfolios, from cautious all the way up to aggressive with higher equity weightings. And once that decision's been made, unless the client notifies the life company of any particular changes, then going forward, any premiums, any contributions going into that executive pension plan will just be invested automatically in whatever portfolio of funds that the client has selected. And the difference with a self-administered pension plan is that when you set up a self-administered pension scheme at outset, essentially all you'll have will be the revenue approved tax exempt pension wrapper. You'll have a pension bank account opened up in the name of the scheme. And when you or the employer make a contribution to that self-administered scheme, the funds go straight into the bank account, and they will sit there indefinitely until you make a decision as to what it is that you do with the fund. So as I said, Emer's going to talk about the options as to what you can invest in, but that's a really important distinction, because clients do sometimes, they kind of lose sight of this, and we do have a number of clients that would have pretty significant cash balances building up in pension bank accounts, because that decision needs to be made for every single contribution as and when it goes into the scheme. Just in terms of the structures then that can be used for self-administered pensions, probably the key determinant as to what the most appropriate structure is for the client, or what the client might select, is really the client's employment status. So if you're a sole trader, or say a professional or an individual employee, even in non-pensionable employment, and you want to set up a self-administered pension, then the option that you'll choose, or in fact is the only option out there, is a self-administered PRSA. If you're a company director, or say a senior employee, and you're looking to set up an occupational pension scheme, then it would typically be a small self-administered scheme known as a SAS. A PRB is what would be used to accept the transfer of a previous occupational pension fund. And you can also set up self-administered PRBs as well. So there aren't too many differences in terms of the investment optionality between the two structures. There are some, but really the key difference between the two is the scope for pension funding. So if you set up an occupational pension scheme, then both the employer and the employee can make contributions. And as you can see on the left, if you set up a PRSA, then you're restricted to making personal contributions as an age-related percentage of your net relevant earnings. So the maximum you can pay is 40% if you're over 60, and the maximum net relevant earnings that can be accounted for is €115,000. Whereas if you set up an occupational pension scheme through a limited company structure, then both, as I said, both the employer and the employee can make contributions. The employee can make contributions up to those same limits, and the employer can also make contributions. And the employer contributions can be multiple times the individual's salary, particularly where you might have a scenario where a company director is drawing a decent salary, but has no previous pension fund set up for that employment, and has a long historical service or salaried service with that employment. And in those circumstances, it can be possible to get many multiples of the individual salary out as a single premium employer contribution in respect of back service. So in the pre-retirement space, there's options for both employed and self-employed, but really the difference between those two structures is the scope for actually funding. It's important to note as well that the self-administered option doesn't stop in the pre-retirement space. So when you take benefits, or even after you've taken benefits and you already have an ARF, you can then set up a self-administered ARF. And most, if not all, of the same investment options are available through a post-retirement self-administered fund, as in one of the two pre-retirement structures. So this move from insured to self-administered can be made at any point, either in pre-retirement, when you actually come to take your benefits, or when if you're already in a post-retirement approved retirement fund. So some of the other kind of basic differences between the two structures, obviously with an insured executive pension plan, the provider is the life company itself. In the self-administered world, the provider will be a pensioner trustee firm. Both schemes are established under trust. An insured pension plan uses a letter of exchange between the employer and the member of the scheme, whereas with a self-administered scheme, the scheme is established under trust using a trust deed. And in the insured world, the employer tends to act as trustee, or else increasingly what we're seeing is the employer appointing an independent trustee. So all of the life companies now will make available the services of a professional independent trustee. Some of them offer that for free, and some of them charge kind of a nominal monthly fee. Whereas in the self-administered world, typically what happens is that the pensioner trustee and the member will also act as a beneficiary trustee on the scheme. So given that there is quite a difference there, it's probably just worth touching on that for a couple of minutes. So as I said, both the member acts, and the professional pensioner trustee firm acts as trustee on a self-administered scheme in most circumstances. And really the member, hopefully in conjunction with an advisory firm, will have the ultimate control over what that fund is invested in. So there is huge optionality around how you structure self-administered pension investment portfolios, but ultimately it is up to the member to make that decision and to drive the investment of the fund. So the pensioner trustee firm then, on the other hand, has two kind of key roles in a self-administered structure. So the first is sort of the general administration of the scheme, so making sure contributions are allocated correctly, and making sure those contributions are invested in line with the members' objectives, and also reporting. So reporting back to the revenue or reporting to the pensions authority. But the other important role, particularly in the context of the member having the investment control that the pensioner trustee fulfills, is making sure that the investments within the scheme adhere to all the Revenue and Pensions Board guidelines. So while there is greater optionality there are still restrictions, particularly around things like direct property, for example, like the arm's length requirement, for example. And it's up to the pensioner trustee firm to make sure that those investment decisions that the member is taking don't cause the scheme to fall foul of these Revenue and Pensions Board guidelines. Excuse me. So I'm just going to talk about IROP 2 then next, which is a pretty significant piece of EU pensions legislation, which is likely coming into law in Ireland fairly shortly. As I said, IROP 2 is EU-wide legislation. We are the only member states at this point to have not fully implemented IROP 2. It was due to be implemented back on the 13th of January 2019, so we're more than 2 years overdue in terms of actually transposing it into Irish law. And IROP 2 will cover all occupational pension schemes, and that includes occupational self-administered pension schemes. So it will have an impact on individuals who are in self-admin schemes as well as those in insured pension arrangements. And really, what IROP 2 is intended to do is to just greatly improve overall scheme governance and risk management. And they've broken this down into a number of different areas, some of which will have more of an impact on self-administered schemes than the others. So the first area is trusteeship. And basically what IROP 2 involves is, for trustees, is just to increase obligations in terms of setting and overseeing the overall operational structure of the scheme, making sure that it operates in a way that's in the member's best interests, including selecting an appropriate remuneration structure, making sure that there's an effective communication process in place for all the scheme members. And as well as those operational elements, trustees will also have to adhere to stricter fitness and probity requirements. So as well as sort of acting with integrity and in the member's best interest, trustees are also going to have to be appropriately qualified and make sure that any new trustees who are appointed to the board are also appropriately qualified to operate as such. Just in terms of that member communication piece that I mentioned, IROP 2 sets out some pretty specific requirements around member communication. And it actually splits members out into 3 groups. So obviously existing members, but also potential members who are considering joining the scheme, and then members who are in retirement as well. And each one of these 3 groups have sort of specific events that there's like a trigger grid around timing of what communication needs to go out to each of these members and what has to be incorporated in that communication. So the things that need to be included are things like the costs of the scheme, the investment performance of the scheme, and information around the options as to how members draw down their benefits when they come to retirement age. There will also be a greater level of investment standards or government's investment standards expected from occupational pension schemes, and this is probably where it will have most of an impact on self-administered pensions. So there's two areas to this. One is basically a risk management system that covers ESG risks relating to the investment portfolio and how it's managed. And in general, the scheme government system has to specifically include consideration of ESG factors impacting the investment of assets. The other point is that member communication must also include information on how ESG and corporate governance factors are accounted for within the investment of the scheme. So ESG investing is obviously becoming very, very topical, very, very, very mainstream. All investment funds, and again, Eamon's going to talk about this in more detail, but all investment funds now have to essentially have an ESG rating as well as a risk rating. And the same applies to clients' investment portfolios. So we don't just have to risk rate them now, we also have to give them an ESG rating as well. But as well as that, as well as just basic ESG impact or ESG considerations around investments, pension scheme governments is also going to have to take into account ESG factors. The other point, which is probably going to have more of an impact on self-administered schemes, is a restriction on the amount of unregulated assets that the scheme can invest in. And I'll talk about this in a couple of slides, but this will have a pretty significant impact on self-administered schemes. So the last piece that IORP2 addresses is that through or as part of the impact of improving governance and overall risk management of EU occupational pension schemes, they hope to encourage cross-border activities within or between member states. So pan-European companies will be able to have a single pension fund for all of their subsidiaries. And as well as that, on the other side, on the supply side, I suppose, pension funds in one member state will also be able to manage IORPs for companies in another member state. So the idea is that there will be an increase in cross-border pension scheme provision within the EU. So as I mentioned, Ireland are the only EU member country that hasn't yet implemented IORP2, and I suppose it's possibly understandable when you look at this slide. So Ireland actually has more IORPs than the rest of the EU put together. We've over 70,000 IORPs within Ireland. But what's interesting is when you look at the numbers of schemes that only have one member in them. So these are essentially typically company directors who set up occupational pension schemes, and these can be either insured or self-administered occupational pension schemes. And you can see that 63,000 of that 72,000 occupational schemes in Ireland are actually one member occupational pension schemes. So it's interesting that this legislation, which is you might argue is sort of intended to make sure that where there are large occupational pension schemes with employees who may not be financially savvy or have significant wealth, it will in Ireland actually impact company directors who typically would be a lot more financially savvy and arguably not need the same level of governance. I'm not saying it's a bad thing, but it's just interesting how it will impact Irish pension schemes in comparison to the rest of the EU. So then IORP2 and how specifically it'll impact self-administered pension schemes. The first point that I mentioned earlier around the investment restrictions is that a scheme's assets must predominantly be invested in regulated markets. So obviously investments like direct property, which still drives a lot of our incoming inquiries, will be restricted to a maximum of 50% of the fund. And it just means that like we don't necessarily think that's a bad thing, but it does just mean that you know, if a client is looking to go self-administered as a result of a specific investment opportunity, then they're going to have to accumulate potentially twice the fund that they would have had to do before IORP2 is implemented. Those ESG considerations that I mentioned do still apply to self-administered schemes as well, although that will primarily fall to the remit of the professional pensioner trustee to make sure that is done. Other implications come in around borrowing. So you can still borrow, typically to purchase property within a self-administered scheme. After IROP 2 is transposed into Irish law, only temporary borrowing will be allowed for cash purposes only, basically. And then again, those same increased trustee duties of care will apply to self-administered schemes as well. So it will be pretty significant in terms of the impact or the potential impact on the self-administered market. So then, just again talking about this move from insured to self-administered, or how clients might decide, if they have determined that self-administered is the route they want to go, how they might plan to do that, and what type of fund that they might need to accumulate in order to do that. We're often asked, what size of fund do I need to set up a self-administered scheme? There is no sort of official restriction on fund size, but we would kind of suggest a minimum fund of around €150,000 before it becomes cost effective to go self-administered, and also then allows the clients the opportunity to properly diversify the investment of the pension fund. So somewhere in and around 150K we would say is a minimum starting point for a self-administered pension scheme. There's a couple of different ways in which you can get there. Or even get to a higher target fund, again, if it's a specific investment opportunity that you're looking to get involved in. The first is obviously basing a plan around premiums and investment growth, and that can be over a 5-year period, a 10-year period, or a 20-year period potentially. So even though, as I say, the initial conversation is often driven by a specific investment goal, this is not something that has to be done overnight. And it can be a move that an individual makes at any point in their retirement funding journey. The other way to potentially get to that target fund size sooner rather than later is to consider the amalgamation of previous pension pots that the clients might have accumulated from prior employments. It can be a very quick way to get there, but there are some potential negative implications of combining different pension pots, and we just need to look at those and talk clients through those before we pull the trigger on combining sort of previous pots into a new occupational pension scheme. So in terms of contributions only, so in terms of that premium and investment growth strategy, putting in a plan into play to accumulate a sufficient fund. Clients are often surprised, particularly with limited company occupational pension structures, as to the scope for funding, as I mentioned early on. So I've used an example here of a 40-year-old director with a €100,000 salary and 5 years historical service with no previous pension fund for this employment. And in this scenario, the company would be entitled to paying a single premium contribution in respect of back service of €450,000. And then if they had sufficient cash reserves to do so, make an ongoing annual pension contribution of €95,000. So you can see that occupational schemes in particular do offer clients significant scope, if the circumstances allow, to extract wealth tax efficiently, because obviously there's tax relief, corporation tax relief available on any employer contributions, and those funds are off the company balance sheet in a pension fund held under trust for the individual's benefit. So there is significant scope to do it, even if you don't have any previous pension pots, or you're not looking at combining pension pots from prior employments. So the other method I mentioned, or the other question we get as well, is, look, I've 2 or 3 other pension pots here, can I combine them into one to get me to that sort of target fund size where it makes sense to go self-administered? It can be done, but it's probably just worth looking at some of the potential negative implications of doing that need to be talked through. So the first obvious one for us is the restriction on death benefits in occupational pension funds. And this is particularly applicable for company directors who are possibly drawing a low salary at the moment, but might have significant funds elsewhere. Because the maximum lump sum death benefit payable from an occupational pension fund is 4 times the individual salary. So obviously, if they combine significant funds into a current occupational pension scheme and then something happens to them, the maximum fund or lump sum that's paid out to their estate is 4 times salary, and the remainder of the fund must be used to purchase an annuity for their dependents. So that's often not an outcome that people want to see, and it's just something that we need to make them aware of if that is relevant to their circumstances. The other point that is probably more relevant to us in a retirement planning perspective is that if an individual has a number of different pension structures or types of different pension structures, then there'll often be different rules as to when and how they can access those different separate pension pots. And it does give us a degree of flexibility if we're running retirement income illustrations or just putting together a plan about how and when they access the different pots. It does give us flexibility around building that client's retirement plan. Whereas obviously, if you combine all those funds into one structure, then you're going to access all of those funds in the same way at the same time. So it can potentially restrict, restrict the degree of flexibility that clients have as to when they take their pension benefits. One way around this is to keep those pots separate in 2 self-administered structures, but look into maybe structuring a co-ownership agreement. So two pension structures can be used through a co-ownership agreement to invest in a particular asset. It can add a degree of cost and complexity to the arrangement, but at least it keeps the 2 pots separate and does away with sort of that reduced level of flexibility if you combine all the pots. One potential positive, an upside, I guess, of combining various pension pots into one structure is that self-administered plans are often priced on a capped fee base. So it'll be a set percentage fee, but capped at a certain level payable every year. And obviously, the more you have in the pension fund, the more cost effective that becomes. So that is one potential upside to combining pots, but again, does need to be weighed up with the other potential negative implications. So my last slide then, just before I hand over to Emer, is some of the types of retirement planning considerations that are maybe more specific to self-administered pension funds than to insured pension schemes. And I split these into 3 separate stages during that retirement funding process. So the conversations around what we do or how we approach occupational pension schemes in the pre-retirement stage often focus on things like wealth extraction. So if a client's company's had a particularly good year, or if they're close to retirement age and they're looking to really ramp up that retirement funding, we'd be talking about wealth extraction and talking about target funding and retirement income planning. Now, those 3 areas aren't really unique to self-administered schemes, but the next 2, the investment of cash, is an ongoing conversation that we need to have, because, as I said earlier, it can be the case where clients make the contributions and then leave the funds sitting in the pension bank accounts, which are currently attracting a negative interest rate of 0.65% per annum. So that is unique to self-administered pension schemes compared to insured pension schemes, where the premiums are just invested in the various portfolios. The other sort of retirement planning consideration pre-retirement, which is unique to some extent to self-administered schemes, is that if you're investing in assets like direct property, then we need to plan well in advance of that point at which you take your benefits to make sure there's enough cash in the scheme to pay out your lump sum entitlements, because the last thing you want to have to do as a client is be forced to sell an asset or something, that even a property, for example, at a time where the market's fallen. So that, as well as sort of investment of that cash earlier on when you're funding, the closer you get to retirement, we need to make sure that you're actually accumulating cash within the pension fund to be able to pay out your lump sum entitlements. So then at the point at which you take your benefits, and we do like to separate this out into a separate stage, even though it is obviously a much shorter, it's kind of like a point in time transaction. You'll, assuming the cash is there to pay out your lump sum, you'll receive your lump sum drawdown. And then all the other assets that you want to continue to hold within your self-administered pension scheme are transferred in specie across into your post-retirement approved retirement fund. There's often a very different investment conversation had then at this stage, because your pre-retirement investment portfolio might look very, very different from your post-retirement investment portfolio. So we do see clients often undergoing pretty significant investment restructuring within their portfolio when they're at this point of taking their pension benefits. And then we move across into the post-retirement space. So you still have, as I said, self-administered post-retirement structures. And what we often see here is clients' investment objectives move from a focus purely on capital growth to a focus primarily on income. Because obviously clients need to take a minimum level of income from their ARF every year from the year in which they turn 61. And in order to meet that minimum income requirement, or to meet whatever, if they've set their income requirement at a higher level of drawdown, as much as possible, clients do like to see that income being generated within the fund, rather than having to actually encash assets. And again, Emer's going to talk about that in a bit more detail. There can be some tax efficiencies depending on how you leave your approved retirement fund in your will, if you've other significant assets outside of the pension fund. So obviously estate planning becomes more and more relevant the older the clients get. And then the last point, I think, is that clients obviously are possibly retiring younger nowadays, and are also living longer. So there is a real need for ongoing investment advice and investment planning, because just like in pre-retirement, in post-retirement, client circumstances change, and you might be looking at a 20 or 30 year investment time horizon. So it's not just a case of constructing the portfolio at the point at which they take their benefits, investing that money, and then that client sort of just sails off into the sunset. There's still a need for ongoing investment advice, financial planning advice, and estate planning, as I said. Okay, so that's it for me. We will now just take that virtual wellness break, and I will then hand over to Emer to talk through some of the investment options within the scheme.
Thanks very much for that, Andy. Good afternoon, ladies and gentlemen. And thanks to the Institute as well for having us here this afternoon. So Andy's covered some of the main differences between self-administered and insured pensions. He's looked at some of the changes that will affect pensions if when IORPS 2 is implemented, and those that will affect one-member schemes, particularly self-administered schemes, if derogation isn't provided for one-member arrangements. He's also looked at fund accumulation and the retirement planning considerations specifically for self-administered schemes. So when that retirement plan is in place and you've decided on the self-administered pension, the conversation very quickly moves to investment options. And that's what I'm going to be looking at today, along with some of the considerations for liquidity and income in retirement. So before we look at advising on specific investments, it's worth really taking a step back to establish what you're trying to achieve with the fund. And oftentimes we've seen self-administered schemes set up for the purpose of extracting cash from a company tax efficiently. And that's really where the advice has ended. So these funds often sit in cash, or they're maybe used to purchase a property without really much thought to the overall risk and investment risk within the fund. And the scheme members are usually busy running their own business. So oftentimes the money sits in cash for long periods of time, and there's no return on the funds. So it is worth taking time to establish a client's risk profile, and this is largely determined by their personal circumstances and their attitude to risk. And the approaches to discuss is generally based around their investment objectives, and that's part of having a clear view of the time horizon that the money is going to be invested. So for an individual now in their 40s or 50s, the investment time horizon is 30 or 40 years plus in most cases. So it's well into their 80s, that investment time horizon. Looking at as well developing a clear growth plan for the funds and not taking on more risk than is needed. And then lastly, understanding that capacity for loss that the individual has, and in particular, the difference between cyclical loss and permanent loss. And generally clients fall within 4 risk categories, so from very cautious to adventurous. And it's typically the equity weighting in the investment portfolio that's the differentiator between the different risk categories. So a low equity weighting for the more cautious investors, and then this is dialed up as you go up the risk curve to the more adventurous investors. So while we mainly rely on equities to provide that growth to meet the investment objectives, the objective of the fund should be to have a well-diversified portfolio at the point of retirement. So spreading that investment across a number of different asset classes, your equities, bonds, commodities, private equity, or cash, and investment managers as well, to reduce the risk of all investments falling at the same time. And when you've determined the level of risk that you're comfortable taking on and that will achieve the investment objectives that you've set out, it's important then to look at the appropriate mix within the pension scheme. And for self-administered schemes, that's really is a vast, there's a vast array of options available for investors looking at self-administered schemes. The first we're going to look at there is for corporate and government bonds, and they're mainly accessed by retail investors through bond funds. And they can be global funds or global bond funds, or very specific themes, for example, emerging markets. And government bonds would be considered at the lower risk of the lower end of the risk spectrum. With stronger sovereign bonds, they're probably yielding nothing if not negative returns at the moment. And then you have the corporate bonds, which would be anything from your AAA rated bonds right down to junk bonds, and the investment return would increase. The potential for investment return would increase as you go down the risk rating on that. Sorry, as the risk rating increases. The next I'll look at is deposits, and particularly in self-administered schemes, the level of funds on deposits has always been relatively high compared to say cash in insured pensions. And this was fine when banks were providing decent returns on deposits. We now have a situation where most self-administered schemes are currently being charged a negative interest rate of 0.65% on deposits. And that expectation is that's unlikely to change in the near future, now that it's been implemented. And if we do see inflation over the next while, this is going to have a massive impact on the on long-term returns. So while there is a place for cash deposits in most pension portfolios, it should be there, I suppose, for short-term liquidity needs. It should be an investment decision rather than just being there as the default. So moving then quite sharply up the risk curve, we can look at private equity, and private equity is allowed through self-administered schemes, and it's generally direct investment in local private companies. There are some restrictions there, so you can't be connected to the company before the investment's made. And the maximum investment that the pension can make is 5% of the value of the pension fund. And that can't represent more than 10% of the ordinary issued share capital of the company. So often we see these investments be made by way of a loan note with a coupon payment, where these restrictions wouldn't apply, but that does cap the potential return. And then at the other end of the scale, you can access private equity through international private equity funds, where the deal sizes would be very significant. And this goes for most asset classes, where you can get global reach through international fund managers, whether it's private equity or property, equities or bonds. And they're more accessible than ever through the self-administered schemes and with the various investment platforms that are currently available in the market. So you can access your best-in-class fund managers at institutional rates, so institutional cost, through these through the investment platforms, and you can switch very easily between underperforming managers, or if you want to come down on the risk scale as you get closer to retirement, it's very easy to switch in and out of funds at very little cost within these platforms. So it really is proper open architecture in the investment world. Personalised equity portfolios is probably less common now maybe than we would have seen 10 or 15 years ago. Clients will sometimes have a couple of cherished holdings that they have in their pension schemes. So we might see the likes of some Kerry Group, Ryanair shares, CRH, but we wouldn't recommend exposure to direct invest equities for most people for more than 10% of their fund, because you do run the risk of permanent loss if the company runs into difficulties. And we would have seen this quite spectacularly in the past with bank shares. And you do need a significant fund to get the level of diversification that you need to really manage risk. And finally, then direct property it does remain very popular within self-administered schemes, and it probably accounts, as Andy mentioned earlier, for about 30% of the inquiries that we receive in Harvest. So I'm going to look at direct property in more detail. And property has always, like I said, it's always been a very popular investment in the self-administered world. And it's often the reason why people set up self-administered schemes rather than insured or self-directed pensions. There are some revenue rules that we do need to be mindful of for direct property purchase. And the first one, which is the arm's length rule, it's usually the one that ends a lot of conversations before they really get started with a lot of potential clients. I suppose the arm's length rule, it's that your pension can't purchase a property that you own personally or that the connected party owns. And that connected party definition is Section 10 of the Taxes Consolidation Act. You can't lease the property to yourself or to a connected party, and the pension can't sell the property to you or a connected party. So it really needs to be purely for investment purposes only. And the general rule of thumb that we would have is that if you have to ask if you're connected to the property, you probably are. So, the idea of buying a commercial premises that your business can trade it from, it might seem like a great idea. The tenant, that the rent is going to be pretty much guaranteed, but it is prohibited. And buying a property that you own personally at the moment, again, could be long-term. It may be very beneficial in terms of your long-term retirement planning and tax planning, but again, it's prohibited. But once you've got over that initial test and you're not connected to the property, the tax advantages are really attractive. So not only are you purchasing the property from gross income, but you've no tax on the rental income, and you've no capital gains tax then on the sale of the property in the future. And in certain circumstances, it might make sense to borrow to finance the property purchase. But again, there's some restrictions on borrowing to finance property purchases through the pension scheme. So there's really only one bank lending, mainly to pensions at the moment, and that's for residential property only. And as Andy mentioned earlier, IORPS 2, if it's transposed for one member arrangements as well as all other occupational pension schemes, it will prohibit company pension schemes entirely borrowing for property purchases. So it's worth noting, though, that they would still be available for personal retirement bonds, for buyout bonds, and for PRSAs, as they don't fall within the IORPS regulation. So IORPS 2 won't eliminate entirely the option to number one, invest predominantly in property if you do have the right structure, or two, for borrowing. And then Lending obviously for ARFs is prohibited, and that's something that has always been the case. So the maximum loan to value allowed is 50% of the purchase price of the property, and that's the banks have brought that down from probably 70, 80, 90% it might have been in the past. It's actually not a revenue requirement, it's a requirement of the bank. All costs, stamp duty, legal fees, fit out, they're all met by the pension scheme, but there must be an addition to that 50% equity that you put up. And the bank's recourse is limited to the property itself. So it's considered much more risky lending for the bank than maybe a normal buy-to-let. And for that reason, the premium, there's a premium on the interest charge. So currently, I think it's about 4.5% plus is the interest rate that's been charged on the lending to the pension scheme. And adding lending to that pension scheme, adding debt to the scheme, it does really increase the risk profile of the investment quite significantly. So there's a possibility that all of the equity in the property could be wiped out entirely. You know, this is usually a permanent loss for individuals because it's limited recourse. The bank only has recourse to the property itself. If there is a fall in the value of the property, they're likely just to go in and recover the value themselves. So finally, then, you know, we'd recommend that the minimum fund size for an individual considering purchasing a property, whether that's with debt or without debt, would be at least 200,000 in the pension scheme before even considering a property purchase. So, well, I've got an example here. I want to look at an example of why you'd look at a property investment through a pension rather than holding it personally. And Andy looked at this example earlier where you had a 40-year-old director, 100,000 salary and 5-year service. So the company can make a significant contribution to the pension on their behalf. So in this case, this lady has 350,000 on the balance sheet of the company, and she's looking at a property purchase, and she's wondering whether to do it personally or through the pension scheme. She has no connection to the property, and it would be purely for investment purposes only. So in this example, if we look at that 350,000 that's available in the company, and you take that out personally, so you're paying half of it in income tax. You then have about 180,000 to invest in property. We're looking at a 5% rental yield on that 180,000 investment, an annual increase in the rent of 4% a year, which is the maximum in the rent pressure zone. So you're paying income tax at the higher rate on all of that rent that's collected over this 10-year period. The value of the property is increasing by 2% a year. If we sell the property at the end of that 10-year period, you've got a small amount of capital gains tax to pay. And the net return then between the combination of the proceeds of the sale of the property and the rent that was collected over the 10-year period is about 260,000. The alternative then would be for the company to set up the pension scheme on her behalf, to take that 350,000 out. The company gets the corporation tax deduction. It's not a benefit in kind. There's 350,000 within the pension scheme to invest in a property. Over a 10-year period, the net rents are collected. So it's a 5% rental yield on a 350,000 euro property now. You have a 4% increase in the rents every year. And the rent is received tax-free into the pension. So you have no income tax on that rental income. At the end of that 10-year period, you're looking at a total rent roll of 210,000 over that 10-year period. The value of the property has increased by 2% a year over the 10 years. So it's 2% a year on the initial investment of 350,000. You have no capital gains tax on the sale of the property. So what I've tried to do here is to really compare, you know, you'd say very much so buying it personally or through the pension, it's apples and oranges. What I've tried to do here is to look at if at that point in time in 10 years, you decided you were going to take all of the money out of the pension scheme, pay all of the tax due, what would be the final result. So The point of 10 years time when you sell the property, you've cash in the fund, you can take, which is the combination of the value the property sold for and the net rent collected over the 10-year period. So you can take 25% of the value as a lump sum, and the first 200 of that is tax-free. If you then pay your income tax, PRSI and USC on the balance, your net return in your hand at the end of that 10-year period is just over 400,000, and that compares to 260 odd thousand if you were to purchase it personally. So you can see that the effect of the gross roll up and the investing that gross money initially has a significant impact on the return that you'll get over that 10-year period. And there are many reasons why it may not be possible to hold the property through the pension. So obviously you've got the arm's length rule, that's going to be a significant one. But if the investment is purely for investment, if the property purchase is purely for investment purposes only, the pension is certainly a vehicle that should be considered for holding property long term. So how does it all fit into the overall retirement plan, which is ultimately to replace your income when you stop earning? And property again can be used very effectively as it does produce that rental income, and you can see that rental flow coming into the pension scheme. So what I've looked at here is an example of an individual who's come to retirement and they have a pension fund of 800,000, and it's well diversified across property and some investment funds. So they take the 200,000, 25% of the value of the fund can be taken tax-free, and 200,000 then obviously is a tax-free amount. The balance then of the 600,000 is transferred into a self-administered ARF. The individual is targeting, in this case, an income requirement of 30,000 euros a year. So 350,000 is used to purchase 2 properties, with a net an income of 17,500 net of costs, which is paid into the pension scheme every year. Then look at 250,000 invested across a portfolio of funds that would be income producing funds, and at an average of 4%, that would be an income paid into the pension scheme of 10,000 euros a year. So to build up that 17,500 of income being produced by the investments within the fund would require then a small amount of just about 2,500 on average of a capital drawdown every year on the fund. And that's really where where the likes of property and income producing investment funds can be very attractive. So if you do have volatility in the market in terms of the capital values of property, or if you have volatility in terms of investment funds, that income stream can really smooth out those fluctuations in property values or fund values, where you're drawing income regularly from the pension fund. So the final area I'm going to look at today is ESG, and Andy spoke earlier about the various impacts of IORPS 2 and when it's implemented, how ESG will need to be factored into it. And the ESG acronym, it stands for environmental, social, and governance. So it's really a three-legged stool. And the risk or the profile of ESG investing, it has risen quite significantly over the last number of years, particularly over the last 12 months. And that's partly down to COVID, people being more aware of our environmental and social issues, but that recently EU legislation has also brought it front and centre. So we've spoken about how IORPS 2 will require trustees to factor ESG considerations when investing pension funds. But there was also legislation transposed earlier this month, which Andy mentioned, which will require all investment funds to rate their ESG credentials. So very much like risk rating on investment funds, there'll now also be ESG ratings as well. So in the past, where you're investing with a conscience, there was it might have meant sacrificing some of the investment returns, but we definitely see the green agenda being central to government policy post-COVID, and will provide a lot of opportunities for individuals to match or to even to benefit from investing in returns from investing in ESG, really using their pension funds to make a difference and to make the money matter. So both, so just to summarise, both insured and self-administered schemes, pension schemes certainly have their place. All pensions should be structured, in line with a client's retirement plan to ensure the investment risk is appropriate and liquidity and income needs are factored in as well. And clients probably do take more of an interest in self-administered pensions, as they see them more of a tax efficient investment vehicle rather than a more traditional type of pension. There are some extra considerations that need to be factored in to control or to manage the control and flexibility that the self-administered scheme does provide. So I'll ask Andy just to rejoin us, as I think there is a couple of questions in.
Yeah, thanks, Emer. Sorry, 1 second. Yeah, there's a few questions in. I might take the first couple, Emer, just give you a chance to catch your breath. There's a few in the chat box as well as the Q&A. So the first question was for myself. With IORPs impacting borrowing, do you see scope for loan LTV borrowing in PRBs or PRSAs as an alternative? And the excuse me, the answer to that is yes, because IORP 2 covers occupational pension schemes. And obviously, a PRB, although it is a transfer of a previous occupational pension fund, it won't be impacted by IORP. And same with PRSAs, they're not classed as occupational pension schemes. So you will still have all the same options in terms of lending, although lending, as Emer said, can be quite restrictive, and the opportunity for clients can be quite restrictive. But the changes that or the implications of IORP 2 are only going to apply to company directors, say, who have an occupational self-administered pension scheme. So I hope that answers your question. Actually, we're saying that it doesn't apply to ARFs either. So post-retirement funds won't be impacted by IORPs either, although you can't actually borrow within an ARF anyway. There's another question for myself here in relation to the death benefit issue I raised when I was talking about amalgamating pension schemes. And it says, in the death benefit scenario, does an annuity have to be purchased, or can the fund be continued in an ARF structure or similar for the benefit of the beneficiaries? So basically what happens is 4 times the individual's salary is paid out as a lump sum first. So to the estate or to whoever they've left it to. But the balance does have to be used to purchase an annuity. So this is typically, obviously, either a spouse or else dependent children. And obviously, annuity rates are driven by long-term bond yields. So annuity rates aren't particularly good at the moment. And that is usually a scenario that clients don't want to see play out. So there are a couple of planning opportunities there where you can try and avoid that situation. But yes, the answer to that is an annuity must be purchased with the balance of the fund after the 4 times salary lump sum has been paid out.
Okay, there's a couple here. If you have a rental property in a self-administered fund on retirement, can you transfer it into an ARF and retain it to pay an income? Yes, it's very possible to do that. You can transfer a property in specie from pre-retirement to a post-retirement, so to a self-administered ARF. It's a re-registration of the property, but there's no change of the beneficial owner, so there's no stamp duty. But it is just a re-registration of the property in the name of the ARF rather than the pension scheme. There's another comment just on the example that I showed of the property purchase and that return of the 400,000. It was after all of the tax-free lump sum was taken from the pension scheme, and the balance of the funds then was taken down, and marginal rate of income tax was paid on it. So that comparison between the 260 and the 402 is both after tax. All taxes would be paid.
There's another question here which I might take, which says, can I amalgamate a UK pension with my Irish PRB? So if you're transferring a UK pension fund over to Ireland, then it has to go into what's called a QROPS structure, which is a HMRC HMRC approved pension plan here in Ireland. So it's likely that you won't be able to amalgamate it with an Irish PRB if you already have one, because that's probably not going to be a QROPS PRB. But there are providers in Ireland that do provide a QROPS PRB structure, which would be very similar to probably to the one that you have already. So it will be possible to transfer it back. There are a number of considerations that need to be taken into account there to make sure that there's no unauthorized payment tax charge or anything like that on the transfer. But it can be transferred over, and even though you then will probably have two Irish PRBs, when you come to take your benefits from those two separate PRBs after your lump sum entitlements, the balance can be combined into one approved retirement fund. So I hope that makes sense.
Yeah, I think it's just after 3 o'clock there. So, Andy, we might just wind it up. I know there's a couple of questions there. We might just ask Chris if you could send them on to us, or if they're anonymous, we'll get back to the Institute with a response to any of those questions, or you can contact us directly, either myself or Andy, at the contact details that have been provided. So I suppose we'd just like to thank everyone for attending today, to thank the Institute for asking us to present today, and Chris as well for your technical assistance today. So enjoy the rest of the day, everyone. Thanks very much, and please feel free to contact either Andy or I if you do have any questions. Thank you.
Thanks.